In this presentation, we discuss retirement tools for farmers. This can be found in Chapter 3 of the workbook. What we're looking at are basically the retirement plans that for the self-employed individual. We'll look at Social Security, traditional and Roth individual retirement arrangements, or IRAs, simplified employee plans, also called SEPs or SEPs, individual 401ks, and then the savings incentive match plan for employees, which the self-employed will also qualify for. One thing about, or important thing to remind you of, the amounts in this information, rules, etc., apply to the 2015 year. These amounts sometimes do change for inflation, so it's important that you discuss this with your plan advisor. There's also a link to an IRS website at the back of the or the last slide that you can go to and find out what current numbers are. Also, it is necessary to consult your tax and retirement advisor concerning any specific situation and determine which plan or plans may be beneficial and help you select the most beneficial plan. Social Security. It's the basic one. Every self-employed individual will pay into Social Security through the self-employment tax. This provision provides retirement, disability, and survivor benefits for the self-employed individual. So it's very important to pay the SE tax to get those benefits. Annual contribution, that's based upon net income from a business or net income from farming. It's computed on the net income from the farm. There's two parts, the FICA or FICA and the Medicare portion. So let's talk about the FICA portion. It's 12.4% of net farm income up to a maximum of $118,500 for 2015. The Medicare amount is 2.4% of net farm income, not subject to a maximum or a limit. Now, net farm income, if it's below $400, no self-employment tax is owed, but also no benefits are gained. You do not get the benefit of retirement quarters. You don't get the benefit of disability or a death benefit. So, something to think about. There are ways around this. The farm optional method allows a farmer to gain a year's worth of coverage. This is basically 4 quarters of coverage to ensure the retirement, disability, and survivor benefits. So you won't get a full level or much of a contribution, but you will get some contribution, because in order to get retirement benefits, 40 quarters are needed. For disability, I believe it's 10 quarters, and the same thing with survivor benefits. So, you need to look at this. Self-employment has a benefit. Paying the self-employment tax, the Social Security has a benefit. So, as a deduction, the amount you pay as self-employment tax, you get to take half of that as a deduction from gross income on the front of the Form 1040. Not 100%, but at least half. Retirement withdrawals, well, we can start those at age 62 with a reduced benefit. We get full retirement age. You have to look at the birth year. Current years, I believe, are 66 plus so many months. Age 70, you get the maximum benefit. You need to consult with your Social Security advisor to get additional information and get some detailed planning pointers, because it depends upon what all is going on as to whether or not it is beneficial to draw at 62, wait till full retirement age, or if you continue farming, wait till you're age 70. So think about those pieces when deciding when to retire, when to start drawing. Some other tools. Traditional individual retirement arrangements, IRAs. Now, one thing interesting, any earnings in that traditional account do not and will not be taxed until they are distributed. There is an annual contribution limit, however. If you're under age 50, the maximum you can contribute annually is $5,500. From age 50 to below age 70 and a half, they have what they call a catch-up provision, allows you an extra $1,000. So The maximum that you can contribute under those is $6,500, or your earnings from self-employment. Now, if your earnings from self-employment is less than the $5,500, that is the maximum you can contribute. Now, the annual contribution is deductible from gross income unless you're covered by, or spouse is covered by a plan at work, or your adjusted gross income thresholds are exceeded. So, plan at work and adjusted gross income, both of those place an impact on how much you can contribute and let it be deductible. Again, you need to talk to your financial advisor, your accountant, to see how those apply, because there are a wide variety of numbers that can affect this, so it's a little difficult to go into that discussion here. A spouse can contribute to a spousal IRA without having earned income, as long as that spouse had earned income, the other spouse, the farming spouse. Withdrawals from an IRA, they can start anytime after a farmer reaches age 59 and a half, but must start in the year age 70 and a half is reached. Like with an IRA, Social Security, get your retirement plan advisor for additional details about contributions and distributions from a traditional IRA. Roth IRAs, a little different, not subject to income or estate taxes. Remember, withdrawals from a traditional IRA are subject to income tax. Roth individual retirement arrangements do not have an income or estate tax bite. The contribution to a Roth IRA, you've got to look at the modified adjusted gross income. That becomes a limitation or a stopping point of where you can contribute. $193,000 for married filing joint or qualified widowers, $131,000 for single or head of household, $10,000 or more if married filing separate and you live with the spouse any time during the year. Any of those will trigger where you cannot contribute to a Roth IRA. And your contribution, well, unlike a traditional that is deductible, a contribution to a Roth IRA, the deduction does not exist. So if you contribute to a Roth IRA, there is no tax benefit in the year the contribution is made. But like I said earlier, any withdrawals from that is not subject to income tax. It can pass to heirs, not subject to estate tax. There's also not a required withdrawal age. So when you reach age 70 and a half, you don't have to take out a required distribution. It can just stay there. The distributions from a Roth IRA, not taxable, except when a distribution is not a qualified distribution. So basically, when it's not a qualified distribution, if you start withdrawing it before it's been in the program 5 years, so it has to be in 5 or more years for it not to be taxable. Another piece is that you can't withdraw it before age 59 and a half unless you become disabled. A disability will allow you to take a withdrawal. Also, if you pass before age 59 and a half, your heirs can start withdrawing it. And there is a requirement that heirs do have to make withdrawals from a Roth IRA. Again, consult your plan advisor for additional details. Now, simplified employee pension plans. Like the others, earnings are not taxed until distributed. There is a contribution limit, that being 25% of net self-employment earnings up to $53,000 for 2015. The contribution to a SEP is deductible from gross income, so you do get to take it off from the front of the 1040, just like a traditional IRA. Withdrawal, again, can begin at age 59 and a half, but must start in the year age 70 and a half is reached. Again, consult your plan advisor for more details on it. SEP. Individual 401ks. Also not taxed until distributed, so earnings grow. 25 or the 2015 contribution limit, 25% up to $53,000. It is again deductible from gross income. Withdrawals, like the other, can begin at age 59 and a half, but must start in the year age 70 and a half. Also consult your plan advisor for more details. Now, a simple, which is a savings incentive match plan, These have been made available for the employer as well, the self-employed. Like the others, earnings not taxed until distributed. There is a contribution limit of $12,500 of net self-employment income. If you're over 50, that amount goes up by $3,000. So the contribution limits, two-tiered, below age 50, $12,500, above age 50, $15,500. Again, the contribution deductible from gross income. Withdrawal can start at 59.5, must start at age 70.5. So in review, these are just a brief overview of some retirement plans available to self-employed farmers that are in addition to Social Security. You've got to consult with your financial advisor. You must closely evaluate which plans are suitable to your situation, will meet your goals and objectives, because all plans can work, but some of them will work better in certain situations than others. Again, there's not a single one answer for everyone. There is no such thing as a silver bullet. Everybody's situation is different. Everybody's plan will be different. For more information on the Farm Transitions material, go to the first website, Farm Transitions, at agecon.okstate.edu. Like I said, I included a link here to the retirement plan information that's at IRS so that you can find the numbers as they change in future years for contribution limits, etc., any rule changes that do occur.